By reaching this point and setting up a savings plan, you've already positioned yourself for reasonable financial success. Congrats! You've taken a huge step towards financial freedom. Depending on your comfort level, you could either continue saving and paying yourself first using your newly created savings plan, or you could continue on to start really building your garden. It's up to you. For those of you who are ready to continue building their financial gardens, the key is to invest some of your savings. In this section, we'll give you some of the fundamentals of investing. So what is investing? While your savings plan at the bank will earn you interest, there are additional places to invest your money and make it grow. For example, you could become a part owner in some of the best companies in the world. You could pick your favorites, or you could even hire someone to do it for you. You could lend your money to your government. You could even become a type of landlord. There are a number of different investment types that deliver these sorts of opportunities, such as stocks, mutual funds, and bonds. And this generation has easy and inexpensive access, which is a huge advantage. Don't let the jargon here turn you off or stress you out. Here are some of the definitions of the major types of investments and some other key terms. First is stocks or shares. When you buy stocks or shares, don't worry, they basically mean the same thing. You're buying a certificate that gives you part ownership of a company. You become an owner or a shareholder in that company. Stocks are traded on the stock exchange, and prices fluctuate daily based on the company's perceived value. Bonds. Bonds are a certificate that give you a share of a loan, and you become a lender. These loans can be made to governments, corporations, or even individuals. You collect interest payments throughout the life of the loan, plus you regain the initial amount that you invested at the end. When you buy a bond, you're the lender. Mutual funds. Mutual funds are a collection of investments such as stocks or bonds run by a fund manager. To use a sports analogy, the stocks are like players on a sports team, and the fund manager is the coach. The fund manager will determine which players are on the team and will acquire and trade players to hopefully create the championship winning team. When you buy into a mutual fund, you're one of the team owners. You should be aware, however, that these fund managers don't work for free. They charge for their services through MERS, or Management Expense Ratios. These fees are a fixed annual percentage taken by the fund manager in exchange for their services. We'll talk more about fees later. REITs. Did you ever wish that you were the one collecting rent instead of paying it, but you didn't want to actually have to deal with finding the right property, purchasing it, maintaining it, and keeping unruly tenants in line? Well, there's an easier way to become a landlord, and it's by purchasing REITs. REIT stands for Real Estate Investment Trust, and REIT units are ownership in a set of diverse real estate assets like office buildings or shopping malls. The REIT management firm collects rent, buys or sells properties, and after deducting their management fee, sends you a monthly share of the rent. ETFs are exchange-traded funds. ETFs are the low-cost cousin of mutual funds. If mutual funds are like assembling a group of stocks to make a winning team, then ETFs are comparable to owning the entire league. The benefit of this is that you end up with a diverse selection of investments. ETFs are not actively managed, and as a result, the MERS, or fees, are extremely low, and fees matter in the long run. We'll discuss more about the importance of fees and diversification later. Okay, we're partway through. Remember that you can look up these terms at any time in the notes section of this app if you need a refresher. Next, here are some other terms that you should know for your bank appointment. Dividends. Some companies pay dividends, which is a portion of earnings or profits sent to their stockholders. Basically, dividends are a reward for being owners of a company. That being said, companies don't have to pay a dividend, it's at their discretion. Companies with a long history of paying dividends tend to be top-performing investments. Capital gains or loss. A real-life example of a capital gain is purchasing a painting at a garage sale for $100, finding out that a collector will pay you $2,000 for it the next day. If you sell it, you've made a $1,900 capital gain. With investing, it's the difference between what you sold your investment for and the original price that you paid. Returns. Returns are simply the total of interest, dividends, and capital gains that are generated by your investments. In essence, your returns are your money's growth, and they're usually expressed as an annual percentage. Risk. We all fundamentally understand the concept of risk in our everyday life. Hiking up a hill is less risky than climbing a mountain, but the emotional rush at the top may vary a little bit. I think we'd all agree that climbing a mountain involves more risk and that it probably delivers a higher emotional reward. Risk, in the investing context, is the same, where high-risk investments tend to have high expected returns, and lower-risk investments tend to have lower expected returns. You have to understand that the higher risk, the higher the potential for loss, like falling off a mountain, and the lower the risk, the lower the potential for loss, like falling down the hill. Risk tolerance. Risk tolerance is simply the risk level that you can handle. In life, are you a climber or a hiker? Risk tolerance not only varies from individual to individual, but also changes with your life circumstances. Mountain climbing might be your choice today, but as you age or start a family, your risk tolerance for climbing may lessen. Risk tolerance is the same with your investments. The rule of thumb here is, if you're losing sleep over your investments, chances are you're taking on too much risk. Your bank or your investment advisor can help you with finding your risk tolerance. All of these investment types can be part of your TFSA or RRSP, or a taxable investment account. Speak with your advisor to determine what's best for you. So now you know a little bit about the different types of investments, but what are some effective ways to set up your investment mix? In the next section, we'll show you some of the tried and true methods to help your money grow.